Welcome Database. Thank you all for being here today. My name is Maddie Watt. I work for the Hive. I'm the Senior Manager of People and Programs, and we appreciate you being here today for Insurance for the Sharing Economy. We have an incredible session for you guys today, a double panel. This is a new format we're trying out. We've got so much to talk about that we had to make it into an extra long session. So hopefully we can fit everything in today, and I'm going to get rolling here so we can get on to the good stuff. So thank you for being here today. Ravi, do you mind popping up the slides? Great, thank you. So for those of you who are new today, welcome to the Hive Think Tank. And for our returning database, welcome back. What is the Hive Think Tank, you may ask if you're new? Well, we are an ecosystem of entrepreneurs, corporations, and thought leaders. We are bringing you events about every other week, 2 to 3 times a month. And we focus on events that have to do with data, AI, blockchain, supply chain, industrials, digital transformation, insurance, insurtech, healthcare reimagined, etc. So we have an incredible presentation for you guys today, and we also have previous talks that I will send the links to so you guys can stay up to date with everything the Hive Think Tank is up to. Robbie, you mind the next slide for me? Thank you. And we want to say a special thank you to our sponsors today, especially Avanta Ventures, who is here with us today. We're so excited to be working with Avanta on all things insurance and insurtech related. So we're going to hear from Sanjiv, who is the managing director of Avanta Ventures, in just a minute, and he'll tell you more about what Avanta is up to. But real fast, I'm going to let you guys know the 2 events we've got coming up. We've got one tomorrow night. This is going to be about the future of food. So if you are interested in this sort of thing, also if you are in a time zone that might be and more of the Asia time zone category, this is going to be for you. Or if you don't mind staying up a little bit later in the evening, if you are in the US, I will drop that link later. And next slide, Ravi. We will be partnering with our friends at the Hive Southeast Asia for that last one. And then for this, we'll be partnering with our friends at Gamuda for digital engineering and construction. This is going to be at the end of February. This is going to be another evening sort of thing if you are on the West Coast in the US. And we are really excited to be talking about all the faces of construction and how that's changing. Robbie, do you have anything to say on this event before you jump into what the Hive does?
No, and so this one is, we have participants from Asia, from Saudi Arabia, and so it's truly a global event.
Yes. Without further ado, ladies and gentlemen, here's Tim Ravi, the managing director of the Hive.
Thank you, Maddie. So we are incredibly excited to be hosting this discussion today in partnership with Avanta Ventures. And so briefly about the Hive. The Hive is an early stage venture capital fund, and amongst different areas that we focus on includes insurtech. So if you are an early stage entrepreneur or have an early stage company, please reach out to us and we'd love to engage with you. And so in addition to the Hive here in the US, we have presence in Brazil, Southeast Asia, India, and middle of next year in Europe. So if there are any entrepreneurs there, please also reach out to us. With that, I'd like to introduce my good friend Sanjiv Parikh to say a few words. This event today is co-hosted and co-sponsored by Avanta Ventures.
Ravi, thank you so much for having us and having me here. Avanta Ventures is the venture capital arm of CSAA Insurance Group. In addition to making venture investments like we have here in our portfolio companies that's going to be speaking, we also run an incubator, our accelerator as well, called Avanta Studios. Avanta Ventures invests in data-centric software solutions that leverage heretofore inaccessible or unavailable data sets to create new solutions that integrate third-party data, AI, machine learning, and analytics to leverage and identify completely brand new solutions. We invest across insurtech, mobility, and fintech, connected home, and other adjacencies to insurance that may be risk-bearing. We're super excited to partner with the Hive. Our relationship goes back many years, and We're thrilled to be here with you today.
Thank you, Sanjiv. So we'll get the first panel started, and if I'd like to introduce Mark Warnquist, the founder and CEO of InShare, who will then introduce his other panelists.
Thank you, Ravi. Thank you, Sanjiv. Thanks for hosting this event, and thanks also for being two of our key investors. I'm Mark Warnquist. I'm the co-founder and CEO of InShare. InShare is an insurtech platform that's focused on solving for the insurance needs of the sharing economy, as well as final mile and logistics. Our company grew out of our experience with Uber, and there are some of the panelists on that you'll hear from today that were and are still colleagues of ours from Uber. We're proud to work closely with the panelists here today. Prior to Uber, I served as Uber's global claims director. Prior to InShare, I served as Uber's global claims director, and before that, had a number of senior leadership roles with leading U.S. and Canadian carriers. JB, it's great to have you here today. Could I ask you please to introduce yourself and Mobilitas?
Yeah, thank you, Mark. So I am Julie Brown. I'm very happily go by JB. So thanks, Mark. I head a commercial insurance arm of CSAA Insurance Exchange called Mobilitas. We are new. We are also pretty much in startup mode, and we are focused almost entirely solely on the gig economy. Our first client was IMAX, Lyft, and we since have expanded into other parts of the sharing economy that are really related to the auto side of the sharing economy. And looking forward to sharing with you ideas and thoughts.
Thank you, JB. We're thrilled to partner with you as InShare with Mobilitas. Over to Max. We worked together at Uber. It's been a lot of long nights there. It's good to see you again. I wonder if you could introduce yourself, please, and a bit of background on your role at Lyft.
Sure. Good to be here, Mark, and thanks to you and the Hive for having me. As you mentioned, we met back in our Uber days. I recognized even some participants from those days on the call, so it's good to have them joining us. Before rideshare, I was actually trained as a pricing actuary, and I worked on energy and marine models out of both London and New York for Zurich. Always gravitated towards pricing challenges, and that's what brought me to rideshare in its infancy, and it's matured quite a bit. So now at Lyft, my responsibility is more than just placing the insurance and all the risk management functions that go along with that, like claims, actuarial, first notice of loss, data science, risk management, but also finding ways to embed our understanding of risk in the product, make the product safer through engineering and product innovation. So that's my current role, and a bit of a teaser on the trajectory that rideshare has been through.
It is a bit of a teaser. So today we're going to focus on insurance innovation and sharing economy. We've got the right people here. For me, I got to say that one of the things I love most about the sharing economy is how the novel operating models, the unprecedented scaling, the ever-evolving products, regulatory environment, all of that good stuff has really demanded and required innovation in the world of insurance. So we're going to talk about what's next. But before we do, a little bit of historical perspective is probably best, an important place to start for our listeners. And Max, if you don't mind, I'd come to you. Sharing economy dates back, some say 2008, some would say it goes back further than that. But let me just go back to the start of peer-to-peer, P2P with Uber and Lyft back in the 2013 to 2017. What were some of the things that were going on there in terms of insurance innovation in that rideshare space?
Yeah, absolutely. I mean, I think it's a good case study for the broader sharing economy, because that trajectory that rideshare has gone through is sort of indicative of of companies in this space more broadly. And it started with just insurance being something that was simply required by law, something that made the business legal. Ultimately, it became what it is today, more of a embedded product and competitive advantage if you can understand it and put resources behind managing it properly. But in its infancy, just making the platform legal was a challenge and required some significant insurance innovation. there's sort of two traditional worlds of how auto policies are underwritten. One is for personal use of the vehicle, and one is for commercial use. Now you're using it to make money rather than going to the grocery store to pick your kids up. And rideshare was some hybrid that no one in the industry really knew how to properly insure and get the right policy language tied to it when we were living in a very binary world. So the transportation network companies, or TNCs for abbreviation, like Uber and Lyft, worked with the insurance industry to find sort of a compromise that basically said, hey, when the driver's been contracted to pick up a passenger, they accept that trip from that moment until they pick up the passenger and drop them off at their location. It's very clear that it's commercial use, and unique things about commercial insurance need to apply there, like higher limits. When the app is open before the driver hits accept, a little bit less clear, right? So they're not actually contracted to use the car for work, and so the liability limits and the insurance structure resembled something like a personal auto policy. And what was needed was the engineering to measure and identify when the car was being used for which purpose, accrue those exposures, so come up with a total mileage for those periods, and then design policies with coverage that responded to that period identification. And so brought on to at scale the advent of usage-based insurance. And if you think about it, that period that we're talking about, where it's very clear it's commercial use, periods 2 and 3, that leaves a lot of insurance for TNCs to go out and procure, which is ultimately what happened, and provide those commercial limits. And so the platforms started acquiring a ton of data, and what was just a barrier to operate became this unlock of unique understanding about exposures and what was going on in the world and what was happening on the platform from a risk perspective.
Huge amount of foundational work being laid in that era from 2013 to, I don't know, 2017-ish. The engineering foundation, you talked about the regulatory foundation, of course, the insurance foundation, just the understanding of risk. We've seen a bunch of maturation as the maturation curve has continued to develop. What are some of the things that you would highlight in terms of the maturing programs for these very large rideshare programs?
Yeah, so I think the first obvious indicator of maturation is the degree of sophistication of partners and partnerships between platforms and the insurance industry. So both rideshare companies sort of started out with partners that maybe weren't as rooted in this particular discipline in auto, specifically in commercial auto, with resources specifically targeted at developing solutions for the sharing economy, and now that's changed. So becoming an insurance partner and providing insurance for a sharing economy player requires a lot of close collaboration, a lot of unique solutions on the claims handling side, on the underwriting side with pricing, and we have the data to have that conversation now. So the data didn't exist initially, so it didn't necessitate and force that close collaboration. We were all sort of looking at corollaries and industry data from the past of taxis and limos and whatever we could find that might look something close to rideshare. But as we learned over time, rideshare is really unique, and requires and has become its own sort of business case in and of itself, and requires that close partnership to develop a mature and sustainable solution to manage the program.
So, hey, JB, in more recent years, we've seen a couple of other newer developments in this space, and one of them, some of us I would call is bring your own insurance in the gig space. Mobilitas and yourself, you're leaders in that space, you're first movers in that space. I'd love to get your perspective on why bring your own insurance might make sense for some gig drivers, and do you see a market for that going forward?
Yeah, thank you, Mark. And Max, thanks for the layout of the foundation from which we can talk about these other things. So I'll answer your last question first, Mark. I think any of these things have a future. It comes down to economics. It comes down to how you structure the product, and everything Max said, how you partner to create the right product with the right coverage at the right price. And then the other part of bring your own insurance is, well, how does the rideshare company or the property share company or whatever part of the sharing type of economy we're talking about really validate not only that that product is there to begin with by the gig driver or the homeowner or whomever is bringing their own insurance, but how is that validated really throughout the policy term? And I think that's the next crux of the thing that has to be figured out. Because just like contractors and traditional insurance, people often buy that required insurance and then maybe let it lapse, right? And it's not there anymore. And that becomes a real problem for everybody involved. I think the other interesting challenge for BYOI right now, particularly in the commercial auto space, is just the cost. If you're a gig driver and you're driving for a few gig platforms and that's not your full-time job, and you realize how much it costs to buy business insurance, which is different than your personal lines insurance, that becomes a very hard pill to swallow. And so how do you make the economics and the processes and the efficiencies work out such that BYOI becomes an attractive thing for gig workers to purchase and bring along? Absolutely future. It's just about figuring out how to make it work for everybody.
How to make it work. Max, what are your thoughts on that? If you could comment on it as well, particularly as we think about, the challenges of underwriting individuals versus, say, large corporate programs. Appreciate your perspective on that, Max.
Yeah, absolutely. So I think I totally agree that this is a huge opportunity. Risk tolerance is an extremely individual decision, and the assumption that we're going to have one policy that covers all gig workers in the same way, I think is unrealistic for a long-term solution. But there's sort of two things that have prevented that from coming to fruition. One is the efficiency of underwriting an individual policy versus having a one policy that covers everyone while they're on the app when that phone triggers the coverage. That those expenses, that cost of acquisition has come down through product innovation and engineering and partnership. And so I think that barrier is resolving over time. And you can get to near the same efficiency from an expense and acquisition standpoint with the right partnerships in place, so that it allows for the individual purchase of insurance and the appetite to match the coverage that a driver wants on the platform. And then two, I think there's the pool of risk is very heterogeneous, so the pricing needs to be heterogeneous, and the carrier has some information to be able to price that heterogeneity, but not all of it. And the platform has some other information that allows the carrier to understand heterogeneity, but again, not all of it. And so what you need is the two to sort of come together, put the data sets together to get a complete view, and and ultimately offer a product that's priced competitively, priced accurately, and becomes a tailored offering for earnings opportunity to better serve the gig workers that are powering the platforms.
Thank you, Max. Appreciate that. Back to JB. JB, you mentioned that Mobilitas is focused on and a player in the sharing economy space. And of course, you're partners with Lyft, as we all know, that's public. I wonder if you might share from an insurer's perspective, what are the kinds of things that a carrier should be thinking about as it thinks about writing exposures in the sharing economy?
Yeah, sure. Happy to. I think rideshare is maybe arguably the most mature part of the sharing economy. And then there's all kinds of other things that are in the sharing economy too. But it still can come down to, from a carrier's perspective, what I'll call three basic buckets, which are very common to traditional insurance as well. There's underwriting, there's coverage, and there's pricing. And so when it comes to underwriting, I do think, as Max has articulated, you end up having to think about some unique things that you wouldn't otherwise think about in this blend of personal and commercial insurance. I think when you have a mature partner, you've got to be looking at now how that partner is doing their own underwriting of their gig drivers or property owners or whatever that is. How are they identifying that heterogeneity and the quality of each member of their network or ecosystem, if you will? And you've got to rely on them to do that, and partner with them to continue to find ways to improve that evaluation. As Max has said, you can't, as a carrier, underwrite each individual driver, especially with the larger companies. So what's the quality of their selection? What's the quality of their ongoing loss control? How are they thinking about partnering to managing claims expense as well as claims indemnity? The second component is coverage. And so because the sharing economy by definition becomes this blend of personal insurance coverage and commercial insurance coverage, you cannot use just a set of traditional insurance products to solve the true problem or the true gap. And that's where rideshare maybe has come the farthest in creating products that cross that bridge and combine them into one product. But otherwise, you're looking at manuscripting to really provide a responsible product in that space. And all of that combined leads you to that last component, which is price. And so where there is historical data, it becomes a little easier to price. But often, since this is a new part of the economy and there are a lot of new players coming into this space, you don't have historical data from which to price. And so now you need to go look for corollaries, as Max suggested, and those corollaries are imperfect. And so then you've really got to have that curiosity and the intelligence and even data to dig down into, well, what about this corollary, this business that looks a lot like this one, is a direct relational type of pricing indicator? And what's different? Which way does that pricing really need to go because it's different on item A, B, or C? And then I'll just add, as part of that pricing component, you can't just rely on ISO in the commercial space. ISO is usually a couple years behind in factoring in trends in their loss costs build. Plus, when you get to sharing economy, that's a subsection of each category. And that subsection may be worse or better than the averages that ISO produces. Ride sharing is a great example, and the impact of social inflation overlaid over that is a great example. Commercial auto isn't a great place to make money these days in the industry. Rideshare is probably on the riskier end of that. And so if you just take an ISO loss cost and overlay an ISO increased limits factor, you're going to be underpriced. So you've got to figure out how to get to a more accurate price by being a lot more curious, a lot more creative in getting there. We're fortunate in our partnership with Lyft that we have an actuarial team there that can really help define and identify those differences and help get to the accurate, but still competitive price for that partner.
Fantastic. Max, Julie was speaking to underwriting, and she was really addressing the concept of portfolio underwriting and the importance of partnering, if not relying on the platform, right, for that portfolio. A key part of that is the trust and safety program that platforms like yourself, like Lyft has, and of course Uber had as well, has. I'd love to get your perspective, Max, on the role and importance of trust and safety as part of your overall, I won't call it risk program as opposed to insurance program.
Yeah, absolutely. And I couldn't agree more with Julie. It's about partnership, right? So, so I think while a lot of platforms are investing in this area and recognize the importance of it, how much they're willing to really share, really partner, really provide transparency, and work on solutions together with their preferred insurance partners like we do with Mobilitas varies, right? And that's where I see the innovation. So, you know, everything Julie said about the industry and industry headwinds, I think it would be extremely naive to just stick our heads in the sand and say, hey, we're immune to those, right? Like we are exposed to them just as every other commercial auto in the count is. However, a standard commercial auto policy that's written on a policy year basis starts off with no understanding of how much the car is actually being used. Where is the car being used? When is the car being used? Some more details about how the driver behaves when they're behind the wheel. There's a lot of innovation targeted at trying to get to this information, but we're really fortunate as a rideshare platform in that the app has to be on in order for you to start working, right? So we have all that really granular information. So when it comes to trying to combat some of the headwinds that have made commercial auto really challenging to underwrite, I think rideshare, while less mature and has less history of data, has a huge advantage in terms of the granularity of data that's available. And and that easily makes up for tenure. We collect billions of miles of data, right? And it's our obligation from a trust and safety perspective, not just to our insurance partner from an underwriting view, but to the riders who use the platform and the drivers who rely on it every day, to make the platform safer where we can, right? And so creating that feedback loop of, hey, we can design some safety initiatives, we can model the accident frequency that results from those. Does it go up or down? Can we create the feedback loop to drive our pricing strategy with the carrier? And there's some really hard trade-offs that a platform needs to make between growth and bottom line view and safety, and depending on the maturity of the company, the leadership team in place, the levers that they choose to pull will differ. But I can tell you, I think rideshare more generally, not just Lyft, but rideshare more generally is in a more mature phase where there's a balanced perspective on all those levers. But I view my job at Lyft as paramount to be really disciplined about how we manage risk on the platform, and really balanced across the whole portfolio.
Thank you, Max. JB, you mentioned a couple of the challenges or things that carriers need to think about as they move into the sharing economy space. Claims is one of them. Claims is very near and dear to my heart. I know something about your claims team, of course, but I'd love to get your perspective, if you don't mind, on how important it is to you, to Mobilitas, to have a dedicated in-house claims team as you're in this space of sharing economy.
Yeah, thanks. So, the magic of an insurance carrier being successful in the shared economy is you got to figure out how to do it better than your competition. You've got to have competitive differentiation that's sustainable. And so one, that does mean in-house claims so that you can be harvesting those learnings and applying them. And two, we'll go back to, it means a great partner. Now, there's two components of the claims that I think become really critical. First of all, in the rideshare world, and even last mile delivery, Mark, as you know, even though it's not strictly shared economy, having a philosophy in your claims organization and driving it through that says, the most important thing I can do for this driver is get their vehicle back on the road, because that is how they're making money. And so having the right repair network that understands that as well, having adjusters that can really drive that, and just being able to articulate to that driver, I know this is important to you and I'm going to do everything I can to get you back on the road. That's absolutely critical in a claim by claim basis. The other piece of it is the more strategic approach to claims. When you have an in-house claims team, you can drive an overall approach that says, what's the data available to me from this risk or this partner? And how can I use that data to drive better claims outcomes? Now, if you can, as a company, drive better claims outcomes, well, then you're lowering costs for your partner. And it's all about the total cost of risk, right? And if you can do a better job of that versus your competition, now you have a sustainable competitive differentiation. We're fortunate that we've been able to build that quality claims organization with those mindsets and with the available information and data to work with.
Awesome. Thank you. Max, if I look over to Europe, I see some interesting things in Europe. At least I do. I think it's probably fair to say that there's, in some areas of the sharing economy, there's been more advances in Europe, or at least maybe the regulations have allowed that, particularly as it comes to providing benefits and protections for gig workers. And I know you spent a lot of time thinking about Europe in a past life. So do you agree with that proposition that Europe might be ahead of the US in that area? And do you think it needs to stay that way?
Yeah, it's a great question, and obviously there's a lot of factors at play as to the environment we're in the U.S. versus Europe when it comes to provision of benefits for gig workers. I think a lot of what's happened in Europe is inspirational, and we should look to our friends on the other side of the pond as some guide as to where the future of work is heading, right? So Europe tends to be more paternalistic when it comes to providing these sort of social programs, and has found a way to administer those benefits that are fluid and work and dynamic with an individual's approach to how they manage their schedule. If they want to work 10 hours a week or 40 hours a week, there's not sort of a binary world that they have to choose between in terms of the benefits and protections that they receive from an employer or in a contractor relationship. The benefits kind of scale up and down and move and are portable with the worker, and I think that empowers the worker quite a bit over there. We obviously don't have the same flexibility in the structure in the U.S. I think that limits the innovation that hinders the innovation that we have done in this country in this regard to make sure that drivers are adequately protected, and we should continue to innovate in that space, no question.
Appreciate that, Max. So one of the questions that I just saw happens to be one of the questions I wanted to ask, and whether it could be to JB or to Max. I'll let you guys fight over it, but it's the question is in a bring your own insurance world. Do you think the driver has an understanding of the level of coverage that they need to be adequately protected?
Well, Max, do you want to jump in? You want me to jump in, or?
We can tag team. Yeah, we can tag team. I'll start. I mean, I think what adequately covered means differs by driver. So I don't think that it's on us to teach that to a driver, but I think that drivers should have access to the information to make intelligent decisions about the risk that they take. And we should make sure that there are products out there in the marketplace that work for each individual driver's situation, risk appetite, and how much they drive, where they drive, and the product should respond to that. So that's all I would say there. I think in terms of that regard, no, I think we think there's a limited number of options out there. I think it's really hard for drivers to understand. They don't have the access to information that makes it clear for them to be able to make that trade. But yeah, I mean, they need to be empowered with the products and the information in order to be able to understand what adequate coverage means for them.
Yeah, and I think I'd pile onto that just a little bit. Insurance remains a complicated thing.
Yeah.
And I'd say the range of understanding certainly varies driver by driver. I don't know how much they understand about their personal insurance, let alone the concept of using their car in both personal and business use, and where the details of variance may occur, even when they do realize they got to buy business insurance, right? Well, what does the deductible change? Does the limit coverage change? That, what are those types of things? So I do think drivers are more knowledgeable today, generally, than they were, say, 8-10 years ago when this was a growing part of the economy. But there is a lot more for them to understand. And the information is certainly much more available than it used to be. So they have a greater ability to gain that understanding of what they really need.
Another question that we received, and I'll go back to Europe for a second, Max, this is probably to you, but in Europe, we saw a major sharing platform not too long ago announce a telematics offering to reward drivers. You probably have seen that. I'm sure you've seen that. Do you see that coming to the United States? Do you see it becoming mainstream someday in the United States?
Yeah, I do. I mean, I think people want it. I think you've seen it with like the Tesla insurance offering. I have so many people brag to me about their safety score. People like having that feedback. And telematics is a nice objective measure. That resonates and is something that folks feel like they can control. I think we're going to struggle in the current environment with how fragmented things are in being able to provide that direct, tangible and actionable feedback to the driver with telematics signals. But I hope it doesn't, I personally think it's a good thing. And I hope it doesn't take, too many years for us to adopt something similar in the US.
How about you, Julie? Do you see that coming to the United States?
Yeah, absolutely. And there are actually several forms these days of telematics. And I think there's probably an additional complexity when it comes to gig drivers working on multiple platforms. Max is right. They actually want it. They want that feedback. And do you create an offering that provides telematics that gives instant feedback to the driver? Hey, you're going 10 miles above the speed limit. Yep. Or is it just sort of after the fact reporting to a dashboard or through an app really for the driver? In the end, it provides benefits for the driver, for the platform, and for the insurance company, because you get an even more segmented and detailed view of how the drivers as a cohort are behaving and how each individual driver is behaving. So it comes back to, that's what's going to allow you to price the product more effectively. And for platforms that offer that and the drivers that want it, it helps them be more competitive.
Here's an interesting question for the both of you that we just received. And so it's one of the things that both of you guys have highlighted is the importance of data and the sharing economy. And obviously it's the gold in the data is the gold. The question really, if I had to rephrase it a little bit, is do you see a world in which the data about driver behavior, which we've talked about, miles, risk per mile, et cetera, do you see that being shared across the financial services industry in a compliant way, or is it, or not? I can see both sides of that. I'm wondering, I'd be very intrigued to see what the two of you think on that.
Yeah, I mean, I think there are benefits if we share data, right? Like when you scale the size of the data pool, your models become more and more accurate and unlock product innovation faster versus having to wait to collect disparate data sources that aren't joined. So from a product and engineering lens, and if I think about like the opportunity set that we could unlock with shared data, no question that's exciting. I think that the key part where people fail and where I hope we as an industry take note as we have access to this and the capabilities to share data is transparency and control. So I think that's where there's compliant, which is one thing, and then there's transparent and compliant. And I think that transparent piece is really crucial, especially when it comes to things like your driving behavior. People should view that as like a passport that they can hold in their hand, take with them from place to place, and have control over who they show it to or not.
Yeah, I like that analogy. That's all I have to offer on that. Max did a thorough job of addressing that.
He did a thorough job. One other question we got, Max, and it harkened back to the European conversation we had a little bit, was around portable benefits. And we've heard a lot about portable benefits in the over the ebbs and flows, frankly. Prop 22, AB5, et cetera. It seems to ebb and flow. New York, Massachusetts, et cetera. What do you think is the principal obstacle to really achieving a significant portable benefit solution here in the US?
I think there's yeah, I mean, I think the regulatory structure is the biggest thing, right? So like we've seen this trend in other benefits, you know, over the course of the last 20 plus years to find benefit plans where you had a pension and you racked up final average pay times years of service. Like that doesn't exist anymore really in that many places. And it was because people wanted to move around with their retirement account from company to company, right? And so that changed. And then, you know, even healthcare now, like a lot of plans focus on high deductible HSAs, and you put money aside in the HSA and you can move it around, and people like that. But there were regulatory changes that needed to be made in order to allow for this. And like an HSA, the concept of an HSA didn't exist. Until that was created. And so I think we need the same sort of, you know, controls and framework that people can operate within. You know, and regulation is not a bad thing. But that there's a lack of clarity right now on how to address this. And I think that's what's kind of preventing everyone from moving forward in a meaningful way.
I think if you Max, one of the questions I think you can answer is what are if you could focus on one challenge that you're focused on in the next couple years in your space, what would that challenge be?
Yeah, I mean, there's a lot of them. I think, you know, at the end of the day, the costs that the platform incurs, which ultimately get passed on to a consumer, and limits the ability to move towards transportation as a service and using the sharing economy, sharing assets, less reliance on own vehicles. You know, the cost for all those things comes down to how often does stuff happen and how much does it cost when it needs to be resolved, right? And so we will be, I think, we have a lot of low-hanging fruits, and we will be busy for a very long time, just trying to improve those two things, reduce the frequency of accidents and improve settlement outcomes when they do happen, you know, through efficiency, and you know, proactive resolving of claims. So I, you know, I sort of what has driven the industry for centuries, you know, managing down loss costs and you know, I think it will prevail, and you know, it's a good thing for the world. There's something nice about that the industry is trying to find ways to mitigate these unfortunate events, and prevent them from happening in the first place.
Well, JB and Max, look, I thank you very much for joining us here and for your insights. It's always great to hear from leaders in this space, and I thank you for being so transparent. Ravi, I'm going to send it back over to you, sir. Ravi, okay.
Quick audio check.
Here we go.
Sorry about that. So thank you, Mark, JB, and Max. So with that, I'd like to introduce Brandy Mayfield, who is Chief Underwriting Officer of InShare for the second panel.
Perfect. Thank you, Ravi. Hey there, Brandy Mayfield here. As Ravi mentioned, I'm with Team InShare, being a startup in the sharing economy and final mile space. Prior to my joining InShare, I built the sharing economy team over at Allstate. And years before that, I was leading commercial product builds for domestic and international commercial insurance at Liberty Mutual. Thanks a lot to a lot of participants on the line. I see some friends and familiar names there, so I'm glad you were able to join us. On our panel today, we have 3 team members. Sanjiv, who you met a minute ago earlier. Sanjiv, anything more you want to say as a hi and hello?
Hi, everyone. Thank you for listening to us or participating here. Looking forward to the conversation.
Perfect, thank you. And we have Pranav, Global Head of PNC Solutions at Swiss Re. Pranav.
Thank you, Brandy. Thanks for having me here. Would you like me to introduce myself now or later?
Now was great, please. Thank you.
Excellent. No, thank you so much, Brandy, for inviting Swiss Re and myself to this esteemed panel. Really looking forward to the conversation. To introduce myself, I head property and casualty solutions for Swiss Re. And basically what that means is you can think of us as the InsurTech data and consulting arm of Swiss Re. We are set up as an independent, we call it the third pillar business unit of Swiss Re. And our purpose is basically to build advanced insurance products as well as tech and data platforms that help the industry and Swiss Re navigate, the changes in the industry. And as we say, create the next for the industry. So in a nutshell, anything and everything that Swiss Re offers to its clients outside of core reinsurance capacity basically comes from our unit. So we help insurers, improve their business processes, build new products, launch new innovative processes, and also in turn, help facilitate transfer of risk to Swiss Re. We're also responsible for what we call strategic partnerships, which is very important in this context. So that's anything to do with non-insurers, so embedded insurance, tech and digital ecosystems, affinity partners, where we are bringing all the wherewithal of Swiss Re, the tech and data expertise, the product innovation expertise to fire up new business models and to create products that suit the business. We work across all property and casualty lines from, property and specialty engineering, cyber, analytics, and consulting. But to today's conversation in auto, I think is one of our most advanced and largest businesses. And we have a whole range of offerings from, owning a full stack telematics company in Europe called Moving Dots. We've also taken a leading edge position in building advanced commercial auto solutions for the industry that leverage a whole range of solutions from telematics to third-party data sources, cameras for driver and road monitoring. So pretty comprehensive platforms. We've also taken a pioneering position, I think, in terms of product development for advanced ADAS or autopilot enabled vehicles, and also building products for EVs. And we're proud to have strategic partnerships with some of the most advanced and largest auto manufacturers and AV manufacturers in the world. We're very proud of. So happy to be here again. We would love to participate in the conversation.
Perfect. Thank you, Pranav. And rounding out our panel is Debbie, Senior Risk Manager at Amazon.
Hi, Brandy. Hi, everyone. Thanks for having me today. Debbie Bisdorf. I manage the third-party programs for Amazon. So what that means is anywhere where we have large concentrations of third parties doing business with and for Amazon, I build insurance programs to help support them and make sure that they're meeting their contractual requirements from an insurance perspective to be able to handle that. So I do quite a few programs in the middle mile space, in the last mile space, and then also in the product liability space.
Perfect. Thank you, Debbie. So our group today is going to talk about UBI 360, what it means for final mile and logistics industries. But before we dig in, the first panel, I thank you so much, Mark and team. It was a great trip down memory lane for me, because as you were talking about how to ensure that those rideshare companies, Max mentioned quickly taking a look at taxi rates. I can tell you on the insurance carrier side, we were doing the same thing. I affectionately remember an afternoon where a team ran over to me and said, the rates for a taxi in that location should be $6,200 a year. And I said, that's great. How many miles a year do you think those taxi cabs are driving? And the team ran off and came back with somewhere between 25,000 and 60,000 miles. So pinpointing a cost per mile for UBI based on that data was a very bad idea. So let's get a little more refined than that today. As we all should expect, UBI is usage-based insurance. There's a common understanding that UBI is a pay-as-you-drive model. And that could be, how much you drive mileage-wise, or that could be how safely you drive. Telematics has been around for years in the personal and commercial markets. We all agree that there's a level of telematics necessary to transition to UBI. But where UBI as episodic insurance is necessary for the gig economy, traditional businesses that need that full-time insurance haven't necessarily adopted UBI quite as quickly. However, many of the logistics companies see ingenuity being deployed for ensuring the gig economy and are trying to figure out how it's going to impact their operations. So, panelists, let's start with Sanjiv. Avanta Ventures, your team has thoroughly been studying telematics in the industry. What do you see as successes in telematics today? And where do you think UBI is headed in the commercial space?
So I think you're correct. Let's segregate UBI from telematics, the two different sides of the coin, perhaps, if you will. And as you point out, vehicle telematics has been around since the 1980s, in reality, when onboard diagnostics, or OBD, ports were created primarily to help with vehicle maintenance and evaluation of exhaust gases and some of these things, right? So, but over the past decade or more, we can bifurcate this into, there are hardware-centric solutions that rely on the OBD port. There's OBD2 technologies, the new standards have gone in. There are the smartphone-based solutions that are out there. So Cambridge Mobile Telematics, which is the hardware-centric one, Arity and Cambridge are both now evolving into mobile-first platforms to capture data and correlate those data sets with a risk score. But then you also have, well, the challenge with those solutions, though, is that the adoption of them, even within fleets, is less than 10 or 15%. So we have a huge adoption challenge here. However, connected vehicle data, which is software centric, which derives telematics data directly off of the vehicle platform, is beginning to be sort of a new use case within this, right? An example of this is a company called Motork, which integrates real-time data from 9 of the 10 largest OEMs. So as insurers and others and fleet managers, what this does is it enables folks to truly, as you were about to talk to, it's not about the per mile based thing, but how are vehicles being utilized? What are they doing? And incorporating some of that behavior automatically into the vehicle. And we are seeing a dramatic shift, especially in commercial vehicles, just like we have in the home. Companies monitor your laptop usage and other things. Well, a vehicle is just another piece of company equipment that does get monitored. So we are seeing greater and greater adoption going into that, which should unlock new revenue streams for the fleet managers and fleet owners, as well as leveraging new types of risk scores. But we're seeing a total shift towards software-centric telematics.
Thank you, Sanjiv. We could spend the next 3 days unpacking the topics you shared there. We'll get back to a couple of them in just a second. I'd like to hop over to Pranav. You have a global view of telematics and how it's being considered in commercial insurance where you sit at Swiss Re. Can you tell us a little bit more about the maturity of telematics and what you're seeing in other spaces? How is it working relative to correlation with losses, for example? And what do we know or not know just yet?
So the first part of your question, I think first of all, I wanted to concur and echo some of the sentiments that Sanjiv was talking about, right? Because I think we're all very excited at Swiss Re about, the move to the connected car or the connected vehicle sort of ecosystem. I think it just will propel the industry forward in many different ways. There are some fundamental concerns that remain, but I think that will be a big step forward. So then coming to your point, I think in general, both on the personal and commercial side, I think we would all in the industry would have hoped for more adoption of telematics. I think the reasons between the two sides are different. On the personal, as we all know, I think happens to be around privacy and adverse selection and cost and all that. On the commercial side, I think we are a bit more bullish about penetration. And the reason for that is I think the stars align much better, between the various players in the commercial side, right? There is alignment of interest between the carrier as well as the fleet owner to do that. But I think the reason I think we're struggling a little bit on the traction, even though you'd think, now pretty much in advanced economies, almost everybody has some sort of an electronics device, a telematics enabled device in the vehicle already. Is I think it's the insurance industry probably, it's our duty to push it more than we have pushed. And I think I'm a little bit surprised because we all know the industry has been having mixed results. So you would have thought that, the industry would push telematics based or newer product constructs more. A point was made earlier around regulation and what it means. So we can unpack that a little bit more. But I think this is generally something that's holding the industry back. And we are very keen as Swiss Re to proactively help in that regard.
Absolutely. Anecdotally, one of the reasons I often hear from consumers is the cost. Can you speak a little bit to where the cost actually sits today with the variety of options and devices that Sanjiv was speaking to earlier?
So I think we feel that the cost is a bigger issue on the personal line side. To be honest, I don't think in the scheme of things, we don't see the cost as a major inhibitor. If I say the top 3 inhibitors on the commercial side, I don't think that is the issue. I think the bigger issue is the ability, doing the grunt work. There is this whole ecosystem of devices out there, right, with different manufacturers, ELDs, different carriers, like the fragmentation in all steps of the data value chain, if you may. I think that creates a lot of complexity. And I don't think that many people have solved for that complexity, for example, for harmonization of data across different device types, for example, right? So I think it is on a nuts and bolts level, I think that is a much bigger issue. You asked another question earlier, which I wanted to come back to, but I'll put it in that context. I think it's too early. You talked about loss ratio. I think it's too early in the industry to have done significant enough data to say, oh, and this is the exact loss ratio and the expense ratio implication. And why I picked that up now is nothing speaks like money. So while conceptually we all buy into the argument of why it's better, I don't think we've seen those nuts, the dollars flow, that hard business cases being made in the industry yet. And I'm keen to hear feedback from people, but I just don't see that enough yet.
I think that is an accurate observation. And even where we, do see some frequency change, it's very hard to take that to a severity level and put a dollar amount to it, other than knowing it's an improvement. So directionally. Yeah.
Exactly. And I think in there, sorry, to add in there, I think the third party costs and, the liability part of, the overall commercial auto equation, that kind of dilutes the whole collision equation, right? And that's even harder to then model, to your point. So.
Certainly. Debbie, I'd like to hear from you and hop in here. As a risk management leader at Amazon, you shared a little bit about the third-party teams that you oversee. Can you share a little bit more about the types of fleet owners and the types of fleets that are involved?
Sure. The big ones that I oversee are the Amazon Freight Partners, which is in the middle mile space, and the delivery service partner programs, which are very similar in nature. So we look to entrepreneurs and help them build their businesses. So they are independent companies who run middle mile and last mile logistics companies. Through Amazon, right, we offer a variety of value-added services for them to help them support their business. And one of those is an insurance program. In the last mile space, I also oversee a flex program, which is really similar to kind of the Uber and Lyft model, where it's gig workers who deliver packages kind of when they want, right? They use an app, they sign up, they get a block of packages and deliver that in their free time. So I oversee kind of two different models for last mile.
Certainly. And can you speak to what types of vehicles are actually being used in each of those models?
Sure. Yep. So the flex model is individual and personal vehicles, right? So very similar to Lyft and Uber, it's bring your own vehicle. In the middle mile and last mile spaces, we have a mix of Amazon owned, Amazon rented, fleet owners own their own vehicles. We use rentals as well. So just a really wide mix of vehicles that we see in those two spaces, which is challenging to the point of like the telematics, right? What we have in an Amazon owned vehicle may look a little bit different than what we get from a rental company. And so that stitching together of what are the data points that we're getting from each of those different vehicles to actually be able to use that data to make assumptions on insurance, claims costs, things like that becomes more difficult over time as your vehicles and your fleet grow.
Absolutely. And with each of those models and the information, I like the way that you kind of said, all of that information getting stitched together. I think we can all agree, telematics is going to enable safer roadways. We don't know exactly how to quantify it just yet, but what else might there be happening that's preventing, telematics and UBI from becoming table stakes? What do we need to be thinking about differently, or what do we need to be doing differently? And I want to ask, everyone here, from an insurance perspective, from a safety perspective, managing large fleets, and from an insurtech perspective, because there are a lot of ways we can triangulate this. But as we've all acknowledged, at 10 to 15% for that fleet adoption so far, we've got a long way to go. I'm seeing nods. Sanjiv.
So sure, I'll start. So look, again, I think we want to segment or delineate between UBI and telematics. So on UBI, right, it's not only usage-based insurance, it's user behavior insurance as well. And so if you brake too hard, corner too fast, or sharply, all these things matter when it goes into your risk score vis-a-vis insurance. And additionally, let's also segment or separate, bifurcate commercial and personal. Within commercial fleets on telematics, I think there's a strong need for both operational efficiency in managing those fleets, as well as effective risk management, which is the insurance side of what we speak about. And that will likely come with increasing, fleet managers are increasingly becoming aware that what they used to manage in Excel spreadsheets or even in an Oracle database or something of that nature now actually needs real data underneath it to be able to make heads or tails out of it. So I think you will see the fleet management companies partner with insurance carriers over the next several years to really identify in-vehicle software-driven telematics solutions. On personal lines, I think there we will be followers to whatever happens in the commercial space. And eventually we will be shifting. Today, insurers have invested a lot in smartphone-based solutions. But those solutions that I mentioned earlier, they're imperfect. The data is not reliable. You cannot really get an accurate actuarial type of set of data that you can actually then run analysis against. And you don't have the history yet in terms of the sheer number of miles driven for actuarial science to kind of kick in and say, here's how that translates to an insurance score. So there are companies out there that are doing that, and investments that have been made, huge amounts. We'll begin to see that, but I think we'll see adoption and innovation in the commercial space, and then that will bleed over vis-a-vis telematics and UBI over into the personal space.
So I'll go next. I'll try to build on the previous point. I think there is if we zoom in on the commercial auto side, right, like you asked Brandy, there is a lot of fragmentation, right? And I think it takes a lot of effort to, like I was saying, stitch an ecosystem together at scale that makes it worth deploying. And so let me give you an example of something that we're doing at Swiss Re in China, for example, right? Where new regulation has come in. Some of the regulatory aspects are easier to come up with. There's a whole set of different challenges. I won't go there. But what we've done, for example, is come in and say, we will create that ubiquitous industry tech platform that on the one end starts to ingest data from all sorts of streaming devices on the truck fleets. Right now, there are a whole ecosystem of device partners, vehicle manufacturers, where it's a very complex technical problem, right? And you have to spend a lot of money to build that platform that now ingests all of this data. And it took us like almost a year just to put together that galaxy of players to give us enough, critical mass of data. And then working with different vendors who are giving road behavior, road monitoring through optical through cameras, and then another bunch of people who are looking at in-dash cams, driver behavior monitoring. Right, start to collect that. Just do the grunt work to collect that data. Okay, now we have access to the raw signals. Okay, telematics and all, and then to start building the actuarials on it. And then to say, okay, now here is the insurance product that now builds off this data. That's a 2-year journey. And that's a very expensive 2-year journey. And we did that because, we had strong backing and a strong request from 3 of the biggest in the world to say, hey, can we work on this? And can Swiss Re come in and facilitate that? Right now, that's a success story of sorts, and I stop there because it's early days, right? We are in early days, and the actuarial results, the statistical, you were asking about the loss ratios and all, time will tell. So in the US now, if you think about it, I would say, or in Europe, the complexity because of the fragmentation is even higher. So my point being, if you really have to crack this, an industry alliance needs to come together, or a few players with critical mass and strong interest in innovation on product and tech have to come together to solve this problem. And then I think a lot of dominoes fall for the rest of the industry.
Absolutely. And Debbie?
Yeah, so I think when we had talked earlier, right, no one party is going to do this on their own, right? It really does take the fleet management companies, it does take the insurance companies, everyone working together to get it right, because without the data from the fleet companies, right, the insurance companies can't really build those models. And so I think it will ultimately be a partnership that solves this problem. And I think it is early days. This is one thing where these companies can't afford to get it wrong. We've seen historically when companies get it wrong, right, it's very impactful. And so I think it makes sense to take the time to do it right and make sure that you have the correlations correct and can actually make sure that what you're charging for from an insurance perspective is what is driving loss cost. Otherwise, it doesn't make sense to do. And so that's the critical piece. I think that Pranav and his team's working through that. We're super excited to see in the future, but I just don't think they're there yet. From an operational perspective, Sanjiv, you mentioned, I think it is there, right? Fleet companies are using telematics to become more effective in how they utilize gas, on how they optimize routes and route efficiency to make sure that, right, they deliver more packages. They're using it to drive a culture of safety, which does impact claims down the line, but we don't see that direct correlation with the insurance yet. So there is a lot of operational uses from a commercial standpoint for telematics that are being used today. And I think the next kind of big thing will be how that translates to insurance.
Right. Thank you, Debbie. I agree. And putting that together with what Pranav was talking about with all of these different pieces of information and solutions, I'm not going to ask, is one source better than another? But can we talk for a second about the different types of information in case our viewers are unfamiliar? And what I'm meaning there is like the variety of variables and the variety of hertz or response rate, just to paint a picture of how different the information is coming from each of these devices. And Pranav, do you want to take that one?
Yeah, I wouldn't comment on individual devices. I think there is a mapping that can be done. It really depends on who it is and which country we are talking about, et cetera, et cetera. I think the bigger challenge for us, the way I would put it, is the breadth of the payload. Right? What do I mean by that? If you have let's say if you have signals coming off a phone versus a dongle versus a connected car, you can say, okay, I'm getting a 1 hertz, 2 hertz, whatever, X hertz signal, etc. You can map stuff to that easier. What becomes a bigger challenge when I say is the breadth of the data. So I'll give you a classic example, right? So the kind of stuff that you can get off an OBD device is different to the stuff you get off a phone. Like distraction, you will not get, right? Many other things you will never get off an OBD that you get off a phone. Now you move to a connected car, and then we are really excited, right? Because the breadth of that payload is amazing, right? And the accuracy of that payload is amazing, that data payload, right? So for example, seat belts, on or off, steering position, pedal position, etc. They're like 100 different variables that you can get off a connected car that you will never get from a phone. And I think, that really makes a bigger difference. Now, coming to Debbie's point, I love it because, that's a really nice intellectual problem or intellectual curiosity. I don't think anybody knows how many of those variables will actually come to a really proven effective, actuarial model, losses will tell.
Yeah.
But I think that mapping is a bigger issue to my mind.
I would concur. I mean, I agree with Pranav is that the quality of the information that comes from existing sources, whether it's OBD2 or smartphone, is severely lacking. The only way to really solve for that is through connected vehicle data. The sheer volume, the breadth of the data, the accuracy, more importantly, of that data is unmatched by the other two modalities. But when we say, what does that mean from an insurance perspective, an actuarial perspective? I don't know that we know today what the correlation of those different data elements is to safety and behavior patterns and so on. We will have to develop those models as we get greater and greater information. I mean, we're talking, to do this, this is really a big data problem. This is not, hey, I need, a couple of hours of driving from 1 or 2 drivers. We need thousands and thousands of hours of driving and miles upon data to really be able to see what does the data tell us about different correlations and how does that wrap into it. So I think, and as Debbie pointed out, it is going to take that partnership from an insurance company and a telematics company and so on, or FMC, fleet management company, and partnering with the likes of, say, the Amazons of the world, the Swiss Re's of the world, and even the Insurers of the world, all together, and Motorx and other connected vehicle platforms, to say, how do we, as a coalition, as a group, begin to and want to think about the implications for that? And that will change cost structure. It won't do it this year or next year, but it should start to have implications as we learn more.
Absolutely. And what about, I mean, I was talking about the vehicle and the person. Is there enough fleet out there actually to meet demand right now? So do most of these fleet owners typically own and lease their vehicles, or what is that looking like?
Yeah, I think across the industry, you're seeing a shortage in vehicles, right? FMCs cannot make vehicles fast enough to meet the demand that's out there. So our fleet, especially during peak times, is very mixed, right? It's a lot of rentals that, like I said before, don't necessarily have the same telematics that the owned Amazon vehicles have. They do have, right, the minimum levels that are required, but it's not the same sophistication that's in an owned vehicle.
So what I'm hearing is we're bringing devices, we're bringing phones, we have the embedded devices in the vehicles, but those don't necessarily match up on any given day, depending on what vehicle you get assigned or who's doing the route.
Yeah,
a lot of great pieces to be putting together.
That's right. Yeah.
Yeah, I'm smiling at one of the questions that just came in. This is my sentiment frequently as I'm trying to do a job to put myself out of business as an insurer. And so the question is, if we get enough information and we're making these vehicles safer, will the need for insurance go away? I'm paraphrasing a little bit, but understanding all of this detail to get to a cost per mile or even eliminating the need altogether. Is that the end game here or not?
So let me take a stab at that one quickly. I'll step back, and I don't mean to tell people what they may already know, but it's interesting, our CEO talks about insurance as a noble business, in that it is a promise to be there for the customer when things go bad. Insurance over the last 600 years is actually what has enabled the modern economy to come about. When just because you have an EV doesn't mean there will not be accidents. There will still always be some form of liability. And the question will become, it becomes a little bit easier perhaps to figure out where the fault lied or what happened, because we do have telematics information and we can do the forensic analysis. It isn't one of he said and he said, or she said and she said kind of thing. We can know exactly what happened and how that came about. But insurance, as it is, will always be a financial underpinning that enables that commerce, that flow of both goods and people to flourish.
Yeah, no, I'll build on that. I think I echo the sentiment on behalf of the insurance industry, Sanjiv. I'll come at a slightly different angle. I think, look, with enough business case justification, motivation, money, anybody can get into the insurance business, right? So if a large OEM or fleet owner wants to do it, sure. And there are case examples, a lot of people running captives, there's nothing wrong with it. I think, so technically, yes. I think the question to be asked here is for those in question, right? Those entities, is that a business you want to be in, right? And so on. So we see also, insurance is a very capital intensive business. And we especially see now that in the tech economy, the cost of capital for I'm sure people like Amazon and the other high-tech companies and the Ubers and the Grabs and so on, their cost of capital is very different to the cost of capital of the insurance industry, right? And then that's why we quite often go into these things where either in a captive or in a quota share agreement or whatever, where Swiss Re puts down, X 100 million of capacity to back a program, right? So I think you have to think about this from a holistic perspective. Do you have a justification to set up an insurance business? Will you be able to pull together all the wherewithal, the actuaries, the tech, the platform, the rating, the third-party data to be able to do justice to it, to risk assess and pay claims? A lot of people get into this business with claims as an aftersight and go out and say, okay, well, I'll get a TPA and the TPA will manage this. And I won't say anything about the TPA industry, but there are mixed views on how effectively TPAs managed other people's money, and sometimes where their motivations are. And anyway, but I won't opine on that. And then it comes to, do I really want to block X 100 million of capital behind a program of this nature, etc. Right? So I think the answer to that depends on different organizations. Not that can't be done.
Yeah, and I think there's a lot of regulatory stuff that people forget about around insurance as well. And so until they make it easier for entrants, there's still a place for the insurers. Brandy, you're not going to be out of a job anytime soon, I don't think.
Well, if I had a crystal ball, there would be some clients that would pay an expense constant per year, and there would be other clients that would pay 6,000% what they pay today. And neither of those is helping with the law of averages to help the industry. So the truth is definitely somewhere in the middle there, Debbie. I see one more question coming in. Go ahead and fill out questions, anything else that you'd like to see or hear about in UBI here with the team. And this one is kind of across the group as well. And so is there a competitive advantage to any of the sources of information and data, embedding insurance either from the OEMs or, and then questions start popping up, thank you. Either embedding insurance with the OEMs or building something outside of the current insurance industry's models to try to attack this?
Go ahead.
I can take a crack because we do a ton of embedded insurance business in this space. So I think the embedded insurance opportunity, I think, has a lot of advantages, not just because of the data access, which is clearly a differentiator, but it's also about access to customer, it's the customer experience, it's the ability to bundle in, seamless claims, etc., lowering of the expense ratio. So we do believe that the embedded insurance model is a good model for what it's worth. These companies do have a competitive advantage, therefore, I believe. I think in the end, this comes down to execution in my mind, right? How well can you execute, your cost of claims? And we've seen these examples, right? People get into it, but then, you are an OEM, but your channel really isn't incentivized to sell. So the product doesn't move. And we've seen cases where, yes, you have something, but then the repair network isn't good enough. And the savings you have on the expense ratio, you end up losing on the LAE or the repair cost, right? So we've seen all sorts of examples. I think it's a question of execution.
Absolutely. And we're getting close on time here. To put a bow on it for those listening in, if you were looking for the silver bullet in UBI and telematics, if we'd known that, someone would have figured it out and we wouldn't have had a full conversation, but there was definitely a spectrum of what we need to be thinking about. And so for final comments here across the team, who's going to win in this space? What does an insurer or an insurtech have to do to understand their client better and take that next step? And I'm not asking you to name any names, but everything is a progression. So what are some logical next steps for the industry to make that leap to the utopic UBI?
Yeah,
So, Debbie.
Sure. I think the partnership between right? The people with the big data, the insurers that have the knowledge, that's going to be what we need to do next, and really understanding what the correlation is between all of the data points that you get from telematics and what are the ones that actually impact loss. That's what's going to be the needle mover in terms of utilizing telematics for insurance.
Absolutely.
I agree with that. I think in my view, I think the industry does need to invest more in innovation, and I don't mean dollars per se. I think we need to have a bit more passion about making it happen, especially on the commercial auto side. I think the industry needs it. I think we would be helping the economy and our clients and ourselves, but it does take a lot of effort to get it done.
Yeah, I'm hearing the information is there. It's up to us to actually scratch the surface and understand what's been made available to execute.
It's going to take an ecosystem. I think Debbie had alluded to this earlier. It will take an entire ecosystem. And it's not just, I think part of the questions were, hey, what if you have all this data, why can't you just do it? It's not a singular set of data. It's going to require third-party data that gets mashed up and aggregated together with the telematics data. There'll be other behavior data that gets included from other sources. We don't know what those sources are today, but that's what will help with the correlation. And that's where AI and machine learning and big data come to play so that we can all collectively figure this out. But it will require this ecosystem to work together. This is no longer a play of any one party or any one sector figuring it out and saying, now I have the solution and the platform. It's a joint, cohesive solution offering.
That makes sense. I like it. I'm going to stick with a data mashup to be successful in UBI for the future. So thank you for that, Sanjiv. Thank you, Pranav and Debbie as well. With that, I'm going to hand it back over to Maddie and Ravi to close us out.
I'd like to echo Matty's comment on chat, and a special thanks to Avanta Ventures and Sanjiv for really pulling together this event and co-hosting this with us, and to you, Brandy and Mark, for moderating this. So thank you to the panelists, Debbie, Pranav, JB, and Max, for participating, and of course, all the rest of you. Maddie?
I just want to thank everyone for joining us today, and thank you to our amazing panelists. We were so lucky to have a double panel today. I love the format. I hope you guys did. We will reach out to you guys with the recording tomorrow, and please be sure to join our future events. We have another one tomorrow night, so I hope I see you guys there. I dropped the link in the chat. Have a great day, everyone. Thanks again so much for joining us. Take care.
Thank you, Maddie.
Bye.